Hi, and welcome to Finextra at Sibos TV. And today we're talking to Ashutosh Kumar of Standard Chartered. And we're going to be talking about one of the really big topics of conversation, Basel III. So, I mean, Basel III is causing a fair amount of anxiety in the banking world, but really, should it? I mean, should it be causing this much anxiety? And what can banks realistically expect from Basel III?
Basel III, if it is implemented the way it is, would reduce global trade by around 2%. Global trade has been growing at around 6% annually for the last 20 years or so, and we expect it to grow around 6% for this year as well. That means because of Basel, trade would reduce by around a third. With all the good intentions, Basel still has quite a bit of unintended consequences on trade finance, as a result of which pricing would go up between 20 to 40%. That is a lot in terms of pricing going up. But the good news is that regulators are listening. There has been very positive and constructive dialogue between the regulators and the industry. If you see, recently the European regulators have come back and said that they would waive away the one-year maturity floor for certain trade finance transactions. That is very positive and good news. As an industry, that makes us very hopeful that things would work out. I would expect the dialogue to continue the way it is continuing, and things and positive results to come out as a result of dialogue in the next few months towards that.
So it's almost like, Basel III is going to grow and be flexible based on dialogue between the regulators and banks. So you're kind of predicting that it's going to change and flow?
I would expect so. I would expect the regulators to be much more flexible because they understand the challenges. These are unintended consequences. They were never supposed to be the way it is currently coming out to be. So they are listening. They are proactively engaging. In fact, the industry is proactively engaging the regulators. We have shown them the information and data, and they realize that this is something they need to do about. If you look from a G20 perspective, the G20 asked them to look at the unintended consequences or the impact of Basel on trade finance. And in the next G20 meeting, I would expect something to come out of that.
Mm-hmm. So moving on to trade finance, I mean, what are some of the emerging trends in trade finance that we're seeing that better serve corporate customers?
I would really take a step back and talk about what are the emerging needs or things that clients, corporates want from their banks. And what clients want is a much more holistic conversation around their needs. The days are numbered for a siloed conversation, which is just a trade conversation or just a cash management conversation. Because what the clients expect is a conversation around their needs and not around the product which their bankers wants to sell to them. We at Standard Chartered have organized ourselves, structured around ourselves to service and take care of some of those needs. Yeah? Let me give you some examples. Yeah? When a client wants to make a payment, he is really looking at two underlying needs which he wants solution for. The first one is around making a payment to a supplier on time and correctly to the supplier. And then the second one is to ensure that the supplier has supply chain financing or financing available so that the supply chain is financed. What we do is we pick up a payment file from our client, put it on our front end, which is straight to bank, and then the suppliers can log into the front end and then pick up the payments which they want financed. Yeah? And we would go and do the supply chain finance. If the suppliers decide or do not want that finance, that's also okay. We would just make a payment at the maturity date. So from a client perspective, they really like it because this gives them a much more holistic view of everything. They are doing two things. They are making a cash management payment, or they could do a supply chain finance in one go. And the clients really love it because this is a holistic view, and this gives them an end-to-end visibility into their procurement as well as the payables process.
Now moving on to sort of this whole holistic view, I mean, a lot of banks have consolidated their transaction bank and integrated their cash management and trade finance. But what does that really mean? Does that mean they've put them all in the same building or the same floor, or does it mean that they've actually integrated their back office payment processing?
I think if any bank just puts them on the same floor and leaves it, nothing will happen. What you need to do is go back to the same thing. What are the underlying client needs that you want to service? And how are you going to do that? Yeah, and that is what we have done it. So what we have done it that I look after both cash and trade. I have a colleague who looks after cash and trade operations. We have somebody who looks at from cash and trade technology. So we have tried to do it. What it means is that the solution which I just talked to you about is looked at a more holistic manner. Let me give you another example. When a client is looking to receive a money, yeah, you can finance that and you can do in a supply chain or any particular finance. But the client also has a need to have a reconciliation, to have the need to know who is this payment coming from. Yeah? And what we have done is that we have again merged a trade finance product and a cash management product, which is like a virtual account, where each of the payments from the client comes into an account and it stays there. So that is the kind of things that you need to do in order to ensure that cash and trade convergence is happening. Because it's not exactly cash and trade convergence, it is actually the needs of the clients which were split into two ways, and now we are bringing it back. So it is ultimately one need of a client.
Thank you very much. Appreciate it.
Thank you, Liz.
Thanks.